$30 trillion over 15 years. That is exactly how we got to these levels. Hi, my name is Mike Minter, and I'm doing a three-part series on the S&P 500 that I call the $30 trillion truth. I am a certified financial planner. I've been in this business for over 25 years, and I want to make it clear that these views are my own, and they are not the views of Main Street Financial Solutions, where I am a partner and also an advisor. So part one is, how did stock prices get here? And before we kind of get into that, we got to go through a little exercise. And the exercise is defining the difference, or looking at the difference between 1 million, 100 million, 1 billion, and $1 trillion. These amounts are thrown around daily, and I really don't believe that many understand how much money $1 trillion really is. So let's look into it. Right here is a stack of $100 bills that equal $1 million. Now, $1 million is a lot of money. If that stack was in front of us right now, I'm sure we would all be very happy. To be honest, I really thought a stack of $100 bills equaling $1 million would look bigger than this, but that is what it looks like. Next is $100 million. So now, instead of having a stack of $100 bills, we kind of have one big cube of $100 bills. For you and I, $100 million, we have that. We're probably doing whatever we want, whenever we want, for the rest of our lives. $1 billion, now if we're talking about you and I, it's kind of silly money, right? Now we're talking top 1% of the country. But to get there, if a cube of $100 bills is 100 million, then it makes sense that 10 cubes would equal $1 billion. All right, now next is going to be 1 trillion. And I want you to know before you see this, that this is accurate and it is staggering. Here we go. This is $1 trillion. Let that soak in for a minute. All right, for scale here on the left, we have a semi-trailer truck. Okay, so you can kind of see how far this money really goes. And you can also see that it's not just a stack of cubes, it's double stacked. But when I showed this to my son and he looked at it for the first time, he said, "Dad, that is an absurd amount of money." And you know what? He's right. So before we get into the charts, let's just kind of look back to before the financial crisis. So on October 9th, 2007, the S&P topped out at 1,565. Since then, we did have the financial crisis. Financial crisis, by the way, which almost took down the entire financial system. So let's make sure, we remember exactly what we're talking about here. And then a little over 10 years after that, we were in the middle of a global pandemic where we were stuck in our houses for over a year. During both of those periods, earnings absolutely collapsed for most companies. So, if you're just kind of thinking rationally, you'd probably say, geez, over that 15 period of time, it was probably a tough time for the stock market. Probably didn't do very well. And yet, last week, on July 16th, our markets closed at 5,667 points. So if you're looking back from the top of October 9th, 2007 of 1565 versus July 16th, 2024 of 5,667, we're talking about a return of over 362%. Another way to kind of look at it too is at the March of 2009 lows of 666, we are now over 5,000 points higher than we were back then. So how did this happen? This first chart is the balance sheet of the Federal Reserve. So you'll notice that before the financial crisis, it was under $1 trillion. And then at the very peak, it almost got to $9 trillion. So $8 trillion of money that they created to buy US treasuries and mortgage-backed securities. Well, that was actually during this period of time. Then COVID came and they bought US treasuries, mortgage-backed securities, municipal bonds, corporate bonds, high yield bonds. By the way, in their charter or bylaws, whatever they call it, they're not allowed to do that. Anything that they buy on their balance sheet is supposed to be basically risk-free. So all of a sudden, when they buy high yield bonds, are they doing what they're supposed to be doing? But they did it. And, here we are today. The one thing I at least appreciate about the Fed is once we got to inflation of almost double digits, they eventually gave up on their transitory comments that inflation was transitory, and they did start reducing their balance sheet. So today it's right around 7.2 trillion, which is still over $6 trillion higher than it was before the financial crisis. The next chart is the Fed balance sheet versus the S&P 500. So the S&P 500 is this gray area here. And the red line is the growth of the Fed's balance sheet. So it's not a perfect correlation of 1, but it is a very strong correlation of 0.92. So for somebody like me that watches the markets and sees something like this, I kind of scratch my head. Because isn't it a little bit interesting that just every time they print money, just seems like the S&P 500 kind of goes with it? Now, I would say that correlation would be even stronger, except for what's happened lately. So we'll see if this correlation stands. If it does, and it continues to be strong, well, one or two things are going to happen. Either this is going to come down or this is going to go back up. As of right now, it doesn't look like the Fed has any intentions of doing QE again, which is the money printing. But they are going to lower interest rates. They obviously really want to lower interest rates, and we'll kind of get into that a little bit more later. My last chart for this segment is this one, which is the total debt of the US government. So again, if we're going back to before the financial crisis, we had less than $10 trillion of debt. Even though this period was really where it ramped up, we were still at less than 10 trillion. And then today we are at close to $35 trillion of debt. So we went from under 10 to 35. So when we ask ourselves, how did stock prices get here? Well, it's a combination of the Federal Reserve and Congress pumping in $30 trillion over 15 years. So again, $30 trillion over 15 years. That is exactly how we got to these levels. Part 2 is going to focus on where stocks are now, and part 3 is going to focus on why you should be concerned. Thank you for listening.